When it comes to investing, people are obsessed with finding the perfect investment portfolio. But the truth is, the perfect portfolio doesn't exist. No one has a crystal ball that'll tell us how our investments will perform in the future. But what we do know is, as beginner long-term investors, we want a strategy that's simple, passive, safe, and low cost. So in this video, I'll break down some of the most popular investment strategies that you can use to get started on your investing journey. If you find this video helpful, don't forget to toss a like and subscribe to my channel for more videos like this one. Before diving into investment strategies, I just want to quickly share the criteria I use for choosing these. First, the strategy must be simple. None of these strategies involve investing in more than 3 things, keeping it as simple as possible. Next, the strategies must be passive. You should be able to set and forget your investment portfolio, and with these strategies, you won't need to check on your investments any more than once a year. We also want to make sure that our investment strategy is safe. Investing in the markets always comes with risk, but each of these investment strategies reduce our risk because they all involve investing in well-diversified ETFs. And if you don't know what an ETF is, I strongly recommend watching my video explaining what ETFs are before coming back to this video. Last, we want to make sure that our ETFs are low cost. All the ETFs mentioned later on will have expense ratios below 0.1%. So with that out of the way, let's talk strategy. The first strategy is the simplest strategy, and that's the one fund portfolio. And yes, you heard that right. One fund, one investment. It's that simple. This strategy involves investing 100% of your portfolio into an ETF that tracks the US stock market. And this is a great strategy for beginners who want to invest in the stock market because you don't need to know what the best stock is to invest in. You're just going to invest in all of them. And historically, this strategy has done quite well. Over the past 10 years, a portfolio that was 100% invested in the total US stock market grew an average of 12.4% each year with dividends reinvested. And that's so much better than what you can get if you just kept that money in a bank account. But it does come with some risk. While in the best year over the 10 years, this portfolio grew 33.4%, the worst year was pretty bad, going down about 19.6%. That's a difference of 53% between the best year and the worst year, which is a pretty big range. Now, if you're interested in this strategy, some great low-cost ETFs to look into that track the total US stock market are VTI and SCHB. If you want to use an S&P 500 ETF to invest in 500 of the best performing US companies, then check out VOO or IVV. All the ETFs you see on your screen have a super low expense ratio of 0.03%. Now, moving on to the next strategy, we have the 2-fund portfolio. When you're younger and have more time until you retire, you're able to take on more risk and invest in stocks since they have more upside. But as you get closer to retirement and closer to living on your investments, you want to allocate more of your portfolio to safer investments that guarantee you a return, albeit with lower upside. So this strategy aims to reduce the unpredictability of investing in the stock market by adding some exposure to fixed income assets, namely bonds. Here we invest 80% of the portfolio towards our preferred US stock market ETF, and then the remaining 20% goes to an ETF tracking the total bond market. And historically, an 80-20 stock to bond strategy has done pretty well too. Over the past 10 years, a portfolio with this allocation grew an average of 10.9% each year with dividends reinvested. And while that's a bit lower than the first strategy, that growth also comes with a bit less risk. In the best year over the past 10 years, this portfolio grew 29.7%, but in the worst year, it went down about 18.9%. That's a difference of 48.6% between the best and worst year, which is lower than our all-stock one-fund portfolio as we'd expect given the reduced risk. So if you're interested in this strategy, some great low-cost ETFs that track the entire US bond market include BND, AGG, and SCHC. All of these ETFs have super low expense ratios of 0.03%. Now, on to our final strategy. You guessed it, we have the 3-fund portfolio. The thing about the first 2 strategies is that they're fully invested in US markets, but don't have any investment internationally. Over the past decade, US markets have significantly outperformed international markets, but as we know, past performance is not indicative of future results. So if you're interested in adding exposure to international markets, pay attention to this strategy. Here we invest 50% of the portfolio into our preferred US stock market ETF, 20% into our preferred US bond market ETF, and then the remaining 30% into an ETF that tracks the total international stock market. Looking at the performance over the past 10 years, a portfolio with this breakdown would have grown about 8% per year on average. And yeah, that is lower than the first 2 strategies, but like I said, the past decade was a great one for US markets, but that does not guarantee the future will be. In terms of risk, over the past 10 years, this portfolio's best year returned 23.5%, and in the worst year, it went down 17.3%. That difference of 40.8% is the lowest range across all three of the strategies, which is what we're going for with this strategy. So if you're interested, some international stock market ETFs to consider are VXUS, IXUS, and VEU. All of these ETFs have expense ratios of 0.07%, making them ultra low cost investments. Any one of these strategies would be excellent for a beginner investor. They're all simple, well diversified, and require little to no work from you to maintain. So with that, thanks so much for watching. If you enjoyed this video, don't forget to smash that like button and smash that subscribe button to see more videos like this one.